Crypto Pirates Daily News, August 25, 2021. Latest news headlines. To avoid crypto betting losses, hold the line. You may soon be able to pay your mortgage in Bitcoin, and here's why. 5 blockchain ETFs to consider if you're interested in cryptocurrency. Why did a crypto geek pay $500,000 for a rock picture? 55% of the world's largest banks have invested in blockchain and cryptocurrency companies. Cardano has increased by 150% in 1 month to become the third largest cryptocurrency. For the last 10 days, Ripple, XRP, has been consolidating. To avoid crypto betting losses, hold the line. The previous few days have been incredibly exciting whether you are a crypto sports betting or simply a crypto bettor. The market had its ups and downs, as it usually does, but the last 96 hours or so have witnessed some of the most spectacular increases in recent memory. This is especially true if you are a Cardano fan, ADA. While the best-rated online sports betting companies do not now support ADA as a crypto bet funding option, it is only a matter of time until they do. And the more Cardano rises, the sooner our favorite bookmakers will include ADA in their banking options. Of course, cryptocurrency may be a fickle mistress, but it's critical that you embrace her in this way. She'll be a severe mistress if you don't. Take a look at the current ADA pricing. After trading considerably below $2 for the majority of the year, ADA reached an all-time high of $2.58 on Friday. It spent the majority of the weekend in that range before soaring to its current ATH of $2.98. That top occurred just yesterday, owing mostly to optimism about the September 12 smart contract implementation. Cardano will eventually give Ethereum a run for its money in the NFT area and the overall DeFi market in a matter of weeks. But, as we've seen today, ATHs are always, and we mean always, followed by modest but major crashes or corrections. The ADA price has decreased to $2.64 after peaking at about $3. We've heard friends and co-workers completely freak out. Of course, when ADA hit $2.58 on Friday, there was ecstasy all around. It's now worth considerably more, and panic appears to have set in for people who should know better. Of course, this is human nature. It's the only way to play the game. However, if you want to win, you must resist the temptation to abandon your wager. This is all too frequent among sports bettors. Every day, thousands of gamblers put money on a sure thing, observe an early inning slip or first quarter collapse, and promptly hedge their bets by betting the opposite way on various live odds. More often than not, this is a loss mitigation strategy rather than a win guarantee one. Of course, bettors frequently count on foregone conclusions before they are foregone conclusions. When that happens, when their initial bet wins despite the terrifying glitches, they make money, but considerably less than if they had simply sat it out. And they make a lot less money than if they had doubled down at the bottom. It's a good thing if it works out. But when it doesn't, it's difficult to remember. The same is true with cryptocurrency, albeit with far higher stakes. Because we're bullish on ADA and have been involved in the crypto platform since its inception in September 2017, we've seen this type of scenario play out in a plethora of tragic ways. Investors buy in, experience some gains, and then panic sell and lose every time the inevitable crash occurs. Consider this true story, as told by a trustworthy friend and hodler. This buddy of ours had a colleague who dabbled in cryptocurrency, which was just entering the mainstream at the time. He'd heard wonderful things about ADA, which was trading at 12 cents per coin. Staking prizes, smart contracts, and so on. All of these features had been planned for years, but they have represented the basic concept of the Cardano platform since its inception. He invested $100,000 in Cardano at the 12 cents valuation and received 833,000 ADA in return. But then the completely predictable and everyday inconceivable occurred. ADA prices have reduced to 6 cents per unit. He went into a frenzy and sold. In other words, this poor man transformed $100,000 into $50,000 in a couple of days. He decided to cut his losses. To be clear, nobody spends $100 large on a crypto stack if they can't afford to lose it. Sure, some people may overextend themselves, but that is always a bad option, regardless of the earning possibilities. You should never gamble more than you can afford to lose. This guy, on the other hand, did not. He was able to afford it. But he panicked and now regrets it. Had he simply hung onto his stack and ridden the ebb, he'd be sitting on $2.48 million at yesterday's ADA ATH of $2.98. That's enough to make an adult cry. The real tragedy, though, is not that someone made a terrible wager and decided to stop the bleeding by leaving early. In most cases, this is perfectly reasonable. We were, of course, in the same boat, and we muscled our way through. Hold the line was our catchphrase. Maintain the faith. This is why ADA is more than just asset appreciation. It is intended to perform actual work, meet the technological needs of entire nations, and serve as the foundation for a new, efficient, and omnipresent kind of informational riches. It is intended to foster unprecedented upward mobility not only for investors and traders, but also for established and emerging markets around the world. It's also intended to decentralize the blockchain verification process so that it isn't reliant on expensive data centers, inaccessible mining hardware, and so on. Stake pools crunch the figures with ADA delegation, and their rewards are distributed to pool members. Remember, none of this was in place when our sad hero abandoned his haul. But he was aware of the possibility. So, while it's unfortunate that this man turned $100,000 into $50,000 instead of the $2.48 million he'd have today if he'd done nothing, that's hardly the worst of it. Consider the following. Currently, a relatively well-performing ADA stake pool pays out 4 to 8% in payouts per Cardano epoch, 5 days. Of course, the percentage is not the return on stake, ROS, for individual delegators. It is the number of ADA earned by a stake pool depending on its total delegated ADA. Those awards are subsequently distributed to all delegators based on the ratio of their delegated ADA to all others in the pool. This man would clear roughly 573 ADA each epoch with 833,000 ADA and an average ADA pool return. This equates to 3,436 ADA each month. He would have made $10,240 per month at the current Cardano all-time high. A whole month. In terms of incentives alone, he'd be able to recoup his whole primary investment in less than a year. This, of course, does not account for the fact that free ADA acquired from staking is added to your stake, so that with each new epoch, you are taking a larger portion of your pool's benefits. We're not celebrating this poor man's stupid decision or his huge squandered opportunity right now. We're simply using it to encourage bettors of all stripes, sports, crypto, stocks, etc. to do their homework, understand what they're betting on and the key factors influencing that bet, and make certain that your mitigation strategy aligns with the future potential that piqued your interest in the first place. Make a Hodl and a Hodl. And, of course, when your betting site eventually accepts ADA, make sure you claim all of your payments in the same currency and delegate them as soon as possible. You may soon be able to pay your mortgage in Bitcoin, and here's why. Mortgages in the United States have taken a step into the unknown, with the nation's second-largest lender announcing that it will soon allow borrowers to make monthly payments in Bitcoin. We're excited that, hopefully, by the end of September, we'll be able to execute on that ahead of everyone else in the country, United Wholesale Mortgage CEO Matt Ishbia said last week during a conference call with Wall Street analysts. Giving consumers who have locked in historically low mortgage rates greater payment flexibility would benefit lenders. However, are there any genuine benefits to paying your mortgage using Bitcoin rather than cash? Possibilities for gain, and problems. UWM, the number 2 mortgage provider in the United States after Rocket Mortgage, feels that adopting Bitcoin will improve convenience for its borrowers. We have nearly 1 million consumers who give us a monthly mortgage payment, Ishbia explains, and if taking Bitcoin or other forms of cryptocurrency makes it easier for our clients, we will do it. In a recent interview with CoinDesk, tech journalist Naomi Brockwell lauded UWM's choice. While Bitcoin has not proven very effective for making payments in the past, she believes mortgages may be a different story. When dealing with significant sums for real estate, this is precisely the type of use case for which I believe Bitcoin is well suited in terms of payments, Brockwell explained. Making mortgage payments may be easier for borrowers with crypto holdings at periods when Bitcoin values are increasing. However, when MoneyWise inquired about the specifics of how the process will work for consumers, UWM stated that it is too early to provide details at this time. Borrowers will be seeking answers to the following questions over the next few weeks. Will UWM take genuine Bitcoin, or will consumers be required to first convert it to dollars via a cryptocurrency exchange? Are Bitcoin sellers liable for additional fees if a third-party exchange is required? What happens if an exchange is delayed or crashes, resulting in a late mortgage payment? Who will set the exchange rate between Bitcoin and the US dollar? Numerous cryptocurrency exchanges publish varying exchange rates. Once we have everything in place, we will explain the plan to consumers, Ishbia said. Additional strategies for making your mortgage more reasonable. If you're a successful Bitcoin investor with a UWM mortgage, spending a portion of your profits to pay your mortgage payments may prove to be a more convenient option than paying in cash. However, this will not alleviate your mortgage burden. There are several methods for accomplishing this. Consider refinancing your mortgage if you qualify. As the economy strengthens and inflation rises, the rock-bottom borrowing prices homeowners have enjoyed for the last year may rapidly vanish. At today's rates, a refinance might save you hundreds of dollars per month. If long-standing, high-interest debts are consuming any remaining cash flow after your monthly mortgage payment, it may be time to explore a lower-interest debt consolidation loan. You'll save money on interest, which will help you pay off your debt faster. Additionally, you can lower the cost of homeownership by lowering your homeowner's insurance costs. When it comes time to purchase or renew an insurance coverage, a little comparison shopping might result in significant savings. Five blockchain ETFs to consider if you're interested in cryptocurrency. Crypto ETFs are less risky and give higher returns in the long run. The waning interest in cryptos contrasts sharply with the growing number of cryptocurrency, exchange-traded funds, ETF filings, with at least 18 applications filed this year. ETFs provide a one-of-a-kind option to participate in a sector indirectly. Nonetheless, U.S. Securities and Exchange Commission (SEC) Chairman Gary Gensler dampened the renewed optimism among Bitcoin (BTC) exchange-traded fund advocates hoping for possible approval for a Bitcoin-based exchange-traded fund, saying digital currencies need much more regulation before they can enter the ETF universe. ETFs are considered low-risk investments. Consider them a mini portfolio because they hold a basket of stocks. Cryptocurrencies, on the other hand, are notoriously volatile. Consider Bitcoin, the world's most popular cryptocurrency. In April, it reached an all-time high of almost $65,000. However, the price began to fluctuate drastically. As environmental and regulatory concerns grew, it fell below $30,000 in June, but has since recovered to more over $48,000, momentarily exceeding $50,000, even as the United States Senate passed an infrastructure measure that would allow for comprehensive control of virtual currencies. As a result, it may appear that ETFs and cryptos are diametrically opposed. However, investing in these digital assets individually may appear difficult. It might be a better idea to set your mind at ease by investing in crypto ETFs. They offer immediate diversification, are more secure, and are listed on major stock markets such as Nasdaq and the New York Stock Exchange, making them tax efficient. Furthermore, while an ETF provides diversification benefits to the holder, it still trades like a stock. So, without further ado, here are 5 cryptocurrency ETFs that are making waves. Number 1. Amplify Transformational Data Sharing ETF, BLOK. Amplify Transformational Data Sharing ETF began trading in 2018. Unlike most ETFs, it does not track an index. Instead, it employs a mixed investment approach that invests capital in a mix of value and growth equities with varying market capitalization around the world, with a concentration on the software and services and diversified financials industries. As a result, it differs from some of the other crypto ETFs available. Hut 8 Mining, HUT, a Canadian cryptocurrency mining company that provides blockchain infrastructure and technology solutions, MicroStrategy, MSTR, a provider of enterprise software platforms, and Riot Blockchain, RIOT, a Bitcoin mining company that provides special cryptocurrency mining computers, are among the major holdings. Also, don't imagine that the company solely invests in cryptocurrencies. When you invest in this one, you also receive some great diversification. After all, one of the fund's top holdings is Square, a financial services and digital payments company. This ETF has a 0.71% cost ratio and is invested in 47 different firms. The 52-week low for Block is $23.40 and the 52-week high is $62.94. Amplify offers a 96% one-year return. Block offers a 1.4% dividend yield and has paid 66 cents per share in the last year. Number 2. Siren Nasdaq Next Gen Economy ETF, BLCN. The Nasdaq Blockchain Economy Index, which BLCN tracks, is designed to quantify the returns of companies involved in developing, researching, supporting, creating, or exploiting blockchain technology. The cost ratio for this ETF is 0.68%. BLCN has $276.6 million in net assets. It is currently trading at a 52-week low of $32.88 and a 52-week high of $53.31. It pays a 60-cent annual dividend and has a one-year return of 28%. Class A shares of Coinbase Global, COIN, which operates a cryptocurrency exchange platform, Class A shares of Square, Advanced Micro Devices, AMD, a global semiconductor company based in Santa Clara, California, that develops computer processors and related technologies for business and consumer markets, and Accenture, ACN, an Irish multinational company, are among the top holdings. Number 3. First Trust Index Innovative Transaction and Process ETF, LEGR. LEGR follows the Index Blockchain Index, which analyzes the performance of firms that use, invest in, create, or have goods that will profit from blockchain technology. According to the ETF's investment philosophy, the fund typically invests at least 90% of its net assets in equities securities that compose the index and has a total of 100 holdings. As a result, the majority of the stocks in its portfolio are from companies in the information technology and finance industries. LEGR has a 0.65% cost ratio and $120 million in assets under management. NVIDIA, a maker of graphics processing units, Oracle, ORCL, a multinational computer technology company, and Wipro, WIT, an Indian multinational that provides information technology, consulting, and business process services, are among the top holdings. Number 4. Purpose Bitcoin ETF, BTTC. Purpose, after launching with more than $590 million in AUM in February, Bitcoin ETF, the world's first Bitcoin ETF, has surpassed $1 billion in assets under management. A 1% management charge is levied on the ETF. It invests directly in physically settled Bitcoin, rather than derivatives, and keeps it in cold storage, eliminating the possibility of trading at significant premiums to the value of the ETF's underlying Bitcoin holdings. This enables quick access to cryptocurrencies without the need to buy and trade cryptocurrency directly through a wallet on an exchange like Coinbase. The ETF's MER management expense ratio, MER, has been set at 1.5%. As a result, if the MER is less than 1.5%, the savings are passed on to investors. Number 5. Innovation Shares Next-Gen Protocol ETF, KOIN. The Innovation Shares Next-Gen Protocol ETF, which debuted in 2018, tracks the Innovation Labs Blockchain Innovators Index and invests in 43 firms. It has a 0.95% expense ratio and a market capitalization of $30.3 million. Bill Gates co-founded computer behemoth Microsoft, MSFT, as well as Nvidia, Visa, V, and MasterCard, MA, the world's two largest payment card network processors. The fund invests in big and mid-cap global technology equities using a passive management technique. As a result, a slew of well-known names are strongly represented in this portfolio. Its 52-week low is $30.63, and its 52-week high is $43.96. The dividend yield is 1.25% every year. Coin has a one-year return of 31%. Because of its holdings, Coin may appear to be more traditional than some of the other ETFs on this list. As a result, if you are a risk-averse investor, this one should be exactly up your alley. Why did a crypto geek pay $500,000 for a rock picture? NFTs are a fantastic innovation that may be even more important than the coins on which they are built. Justin Sun, a cryptocurrency entrepreneur, stated on Twitter a few nights ago that he had paid $500,000 for a photograph of a rock with laser eyes. It wasn't even a good rock photo. It, like the majority of non-fungible tokens, has little to no creative quality. Whether it's the original CryptoKitties, penguins in hats, or the rocks, it's all crypto community internet kitsch, a big inside joke that only the cool crypto kids are meant to get. While the rest of us shrug, the geeks buy and sell these assets, raising prices to unsustainable levels. They claim that we just don't grasp it. It's totally clear to me. First and foremost, NFTs are an astonishing breakthrough that may be even more essential than the cryptocurrencies on which they are built. NFTs create property rights in the digital realm where none previously existed. According to Katya Fisher, writing in the Cardozo Arts and Entertainment Law Journal, The first sale doctrine in U.S. copyright law states that it is allowed to resell or otherwise dispose of tangible copies of copyrighted works. Until now, no such safeguards existed in the digital domain, since digital copies of a work of art were thought to be fungible, and a digital first sale right could not exist with digital works due to their fungibility. When a person purchases a physical painting, he or she is only purchasing the painting itself, not the rights to duplicate it. NFTs function in a similar manner. The fascinating thing about NFTs is that they aren't currently being employed for that purpose. They're being exploited to speculate about nonsense. There are actual digital artists whose NFTs are trading considerably below the penguins and low-res cats, such as David McLeod and Alberto Saveso. Sure, Damien Hirst recently sold a slew of dot portrait NFTs that have skyrocketed in value, and Beeple recently sold his digital mosaic Everydays, the first 5,000 days, for $69 million, but Hirst is the most famous fine artist of our time, and there has been much debate over the artistic quality of Beeple's crude, daily sketches. One aspect of this bull market has perplexed me over the previous year. The best performing assets have been the dregs, companies like GameStop Corporation and AMC Entertainment Holdings Incorporated, junk bonds with negative real yields, and 24px NFTs. Rather than racing out and purchasing the best assets, speculators are purchasing the worst. The Wall Street Bets crowd could easily have purchased Apple Incorporated, but they did not. Financial historians will look back on this period with a mix of awe and dread. Because NFTs are non-fungible, they are essentially collectibles. There have been a few collectible bubbles over the years, with Beanie Babies being the most well-known example from the late 1990s. The implosion of the Beanie Babies had no systemic consequences, but it was notable for being perfectly timed with the rise and fall of dot-com stocks. Collectibles bubbles tend to be synchronous with other asset bubbles, and actual physical collectibles, from comic books to sports memorabilia to sneakers, are blazing right now. However, one distinction between the physical collectibles market and the NFT industry is that tangible items have a finite quantity. New NFTs are being minted all the time as high prices entice new entrants. Some people told me about their children minting new NFTs for as little as $20 and then selling them for $1,000. This is happening thousands of times around the country as tech-savvy youngsters try to get in on the action. Jens Parson highlighted how attitudes around money changed in Weimar Germany in Dying of Money, Lessons of the Great German and American Inflations. When money was so easy to get by, one took less care to obtain actual worth for it, and frugality grew to seem immaterial. Money is so easy to come by in 2021, and speculation is prevalent, just as it was in Germany in 1920. What stage of the cycle are we in when people pay $500,000 for crudely painted rocks? "55% of the world's largest banks have invested in blockchain and cryptocurrency companies." In 2021, banks will continue to be interested in blockchain and cryptocurrencies as they seek to capitalize on the burgeoning asset class. According to new statistics from Blockdata, a CB Insights firm, 55 of the world's top 100 banks in terms of assets under management have invested directly or indirectly in crypto and blockchain companies. Barclays takes the lead with 22 investments in blockchain and cryptocurrency startups, the analysis revealed, and is now the most active investor in the field. Barclays has invested in startups such as Everledger, which uses blockchain and the Internet of Things to provide supply chain transparency, and A3, a provider of corporate technology and services and the creator of the open-source distributed ledger technology project Corda. Barclays is followed by Citibank with 14 investments, including Chain, Digital Asset, and Congo, BNP Paribas with 9, including Metron, TradeX, and Token, JP Morgan Chase & Company with 8, including Consensus and Axone, and Goldman Sachs with 8, including Coinmetrics, Circle, and Veeam. Due to the fact that funding rounds involve a large number of investors, it is impossible to ascertain how much investment each of these banks has contributed in total. As a proxy for this, BlockData examined the valuations of the rounds in which they participated to determine whether financial institutions are making significant bets on the space, and then ranked them appropriately. Standard Chartered was identified as the most active investor in the largest funding rounds, $380 million in 6 investment rounds, based on this data. Standard Chartered has invested in Ripple, a blockchain-based digital payment network and protocol, Dianrong, a supplier of supply chain finance for small enterprises, and Metaco, a Swiss firm focused on digital asset custody. Following Standard Chartered is BNY Mellon, $321 million in 5 investment rounds, and Citibank, $279 million in 14 funding rounds. Concentrate on cryptocurrency custody. A closer examination of investment trends reveals that banks are investing significantly in crypto custody. Crypto custody solutions are third-party suppliers of digital asset storage and security services. Their services are primarily geared towards institutional investors such as hedge funds that own significant amounts of Bitcoin, Ether, and other cryptocurrencies. The surge in interest in custody services is a result of growing investor desire for exposure to the new asset class. CVVC, a blockchain-focused early-stage venture capital investor based in Switzerland, has identified 2021 as the tipping point for cryptocurrency and digital asset acceptance, noting in its most recent industry report that over 14 private, retail, and online banks were active in the digital asset space. According to interviews with senior executives in the Swiss financial sector, the market will see additional digital asset offers later this year. According to BlockData, 23 of the top 100 banks in terms of assets under management are either developing custody solutions themselves or investing in startups that do. Along with Metaco, other custody and security service providers backed by the top banks in the world include Fireblocks, Paxos, Nidig, and Cobalt. This month, Switzerland's DLT Act went into effect, bringing numerous reforms to the legal framework governing the use of decentralized technologies like blockchain. The new legislation, among other things, establishes so-called ledger-based securities and the DLT/security token exchange, a new type of licensing for trading venues for digital assets. DLT trading platforms specialize in the trading of DLT-based securities, cryptocurrencies, and utility tokens. They are distinguished from traditional trading venues and token exchanges by their ability to service retail consumers, their ability to clear and settle transactions using DLT securities, and their ability to safely store DLT securities and tokens. Cardano has increased by 150% in 1 month to become the third largest cryptocurrency. A little-known digital token linked to the Cardano blockchain has recently surpassed other prominent altcoins to become the world's third largest virtual currency, as network developers seek to capitalize on the global increase in decentralized finance. Cardano's native coin, ADA, is being traded on cryptocurrency exchanges such as CoinSwitch Kuber and has withstood a huge price crash warning to reach an all-time high, exceeding the previous record. On Friday, the ADA US dollar exchange rate topped $2.56 for the first time, capping a 154.54% price hike that began on July 20th. This was accomplished despite renowned trader Peter Brandt's warning of a price drop based on a common bearish pattern known as the Head and Shoulders pattern. With the price of the ADA token increasing by over 50% in the last week, there is rising optimism that new technological improvements may enable Cardano payment systems to be operational sooner than the originally announced deadline of September 12. This will enable its network to deliver profitable services like as DeFi, where Ethereum currently has a leading position. As the ADA prepares for DeFi, an upgrade is in the works. In anticipation of the planned Alonzo upgrade, which is set to be launched on September 12, ADA investors are driving Cardano's value upward. Cardano will be able to establish itself as a credible contender in the decentralized finance (DeFi) field thanks to the Alonzo upgrade, which will bring smart contract capability to the blockchain. Because of its still relatively low price and great marketing as one of the prospective Ethereum killers, ADA is one of the most sought-after cryptocurrencies for beginning traders. There is little reason to doubt that Cardano is a crypto world favorite, and ADA is one of the most sought-after cryptocurrencies for beginner traders due to its still relatively cheap price and potential future. Cardano's ability to handle smart contracts, self-executing agreements between buyers and sellers, has resulted in constant gains for the token, while Ethereum, Cardano's main opponent, continues to dominate the burgeoning $100 billion decentralized finance market. The Solana blockchain ecosystem has recently begun to take shape with DeFi and NFTs, but despite the fact that Cardano has no practical use cases as of yet, the cryptocurrency's market capitalization is around 4 times that of Sol, which is $20 billion. Cardano has nearly risen from the ashes thanks to speculators and the promise of a superb and highly transparent development team. What exactly are smart contracts? Smart contracts, also known as blockchain contracts, are distinguished by the way by which they ensure transactional compliance between the two parties involved. One of the most distinguishing qualities of a self-executing contract is its immutability. It indicates that once codes, regulations, and even transactions are put into the blockchain, they are difficult to reverse, alter, change, or tamper with. Smart contracts, like traditional contracts, are agreements between 2 or more parties that do not require the involvement of a third party to monitor or enforce the agreement. It is entirely self-executing. The blockchain network retains a transaction record that is accessible, secure, and immutable as part of its functioning, guaranteeing that evidence of ownership is established and transferred. Contract discussion and application are made far more accessible, and the entire edit record of the transaction is made public to all parties involved. Cryptocurrencies are on a bullish streak. People who use decentralized finance, often known as DeFi, are putting financial functions directly onto digital ledgers, allowing users to conduct tasks such as lending or borrowing cash and collecting interest in a savings-like account without the need for traditional middlemen such as banks. Its increasing popularity is part of a larger trend of increasing blockchain usage, which is becoming more mainstream. A recent surge in the value of cryptocurrencies such as Bitcoin, Ether, ADA, and other tokens pushed the cryptocurrency market to cross $2 trillion this weekend, a first since the mid-May meltdown. ADA is among the top 5 best-performing cryptocurrencies, with a gain of 1,300% in only 1 year, beating increases of 1,030% for Binance Coin, 330% for Ether, and 59% for Bitcoin, among others. The token, on the other hand, is particularly exposed to the massive volatility of the broader cryptocurrency market. The value of ADA plunged by about 90% as a result of the RBI's crypto crackdown in 2018, ushering in a years-long bear market for the nascent sector. However, with the establishment of renowned crypto exchanges in India, investments in crypto assets increased from $200 million in 2019 to $40 billion in 2020. CoinSwitch Kuber, India's top crypto exchange, currently has over 9 million registered customers who have invested in cryptocurrency. All eyes will now be on the September 12 Alonzo upgrade and how it relates to ADA's current winning streak. If all goes well, ADA might emerge as a key challenger to Ethereum, ushering in a new era in the cryptocurrency industry. For the last 10 days, Ripple, XRP, has been consolidating. XRP is one of the most popular cryptocurrencies, but it has encountered stiff resistance from the Securities and Exchange Commission, which requires it to be classified as a security. While the problem caused by this litigation appears to have subsided, a later rally coincided with the broader crypto market. Ripple is not merely a banker's joint venture, it is rapidly advancing towards smart contracts with a fresh upgrade plan for its XRPL. As you might have predicted, XRP is joining the smart contract space with XRPL, but the process is as straightforward as it sounds. The inclusion of XRPL in smart ledger contracts will pose a challenge to Ethereum and other cryptos that enable smart contracts, eroding their market dominance. Over the previous year, the growth of decentralized finance, DeFi, and smart contracts has piqued XRP's interest in the sector, leading to the creation of the federated sidechains within XRPL. Analysis of the XRP price. XRP has climbed more over 160% since the July 21, 2021 lows, raising eyebrows as it gained more than expected in light of the ongoing SEC case. While the highs were not unprecedented, the rally was noteworthy. Interestingly, the rise of the RSI from oversold to overbought zones within a month signals a significant transformation taking place in this crypto industry, especially with XRP. XRP was able to reclaim support from the level on August 18 and achieved a 23% rise over the next 3 days. However, these consolidation zones will be dismantled as a result of profit booking. One must be prepared to profit from any sell-off and re-enter the XRP area. The 200-day moving average, which serves as a solid benchmark for evaluating the price of any asset, is currently 35% below the current price of $1.161, which XRP is trading at following a 9% drop yesterday on August 24, 2021. One should anticipate profit booking in XRP as long as immediate support remains active around the $1 physiological level. XRP has reached a bottleneck level following a big breakout at the $1.05 levels. At the moment, we have good support at 80 cents and resistance at $1.30. There is a high possibility of a correction below $1, followed by a bounce to $2. This price analysis is based on a decline in buying mood over the last 10 days, which was accompanied by a decline in volume. As long as the RSI remains above the 50 level on a histogram, XRP should recover. The combination of support levels and the RSI would indicate the ideal time to add further XRP coins. On hourly charts, there has been no change in either direction as XRP consolidates in a narrow range. While the RSI suggests an oversold condition with histogram values below 40, the MACD indicates a bullish divergence, signaling an imminent upward trend. According to our Ripple price prediction, if XRP overcomes the resistance level of $1.32, it should enter a consolidation phase with a significant bias towards profit booking. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.